Why hasn't the stock market crashed? Not, why hasn't it gone down a little? Not, why isn't it slowing? But why, despite every warning signal flashing red, does the market continue to rise as if gravity no longer applies? If you pause the noise, ignore the headlines, and look only at the core numbers, the market we're living in today should already be in pieces. Every historical pattern says so. Every valuation metric confirms it. Even the investors who've survived the worst crashes in history are quietly stepping back. And yet, nothing has broken. No free fall, no panic, no mass liquidation, just record highs again. It feels less like a market, and more like a rigged illusion that hasn't detonated yet. And that is the part almost nobody understands. The market is not rising because it is healthy. It's rising because something else, something bigger, more engineered, more fragile, is holding it up from underneath. A hidden mechanism, a deliberate strategy, a silent countdown. Before you go, take 1 second that changes everything. Like the video, subscribe to the channel. Join the ones who refuse to just watch life, but choose to shape it. Once you understand it, you'll never look at a bull market the same way again. Because the real question isn't, why hasn't the crash happened? The real question is, what force is delaying the collapse, and what happens the moment it stops? And before we go any further, here's the first psychological moment to act. If you're rewatching this because you sense something is wrong, trust that instinct. Most people ignore the early signals. They only react when it's already too late. Don't be one of them. Now, let's begin where every great financial story truly starts. With the numbers. Not opinions, not predictions. Just raw reality, the kind that never lies. Numbers don't have emotions. They don't care about optimism, headlines, or market confidence. They simply tell the truth. And right now, the truth is louder than ever. Let us start with the metric Warren Buffett himself calls the single best measure of where valuations stand at any moment. The total value of the entire U.S. stock market compared to the size of the U.S. economy. Market cap versus GDP. When this ratio is around 70% to 80%, the market is healthy. When it crosses 100%, the market is officially overvalued. In 1999, at the peak of the dot-com bubble, it hit 115%. And what followed was a collapse that wiped out 60% of the Nasdaq. Today, not 115%, not 150%, not even 180%, over 216%, more than double the size of the entire U.S. economy. If the market behaved today the way it did in every other era of history, it would already be deep in a crash cycle. It would already be unwinding the excess. But it's not. And the distortion doesn't stop there. Look at the top companies, the giants of the S&P 500, the same corporations holding up the entire index. Their average price-to-earnings ratio is now 66. A normal, stable business trades at 15 to 20 times earnings. Tech companies, maybe 25 or 30. But 66, that means investors are paying 66 US for every $1 a company actually earns. It is like paying 60-68 for a burger that should cost $1. Not because it tastes better, but because everyone thinks the price will go even higher tomorrow. That's not investing. That's financial hypnosis. And yet the buying doesn't stop. So ask yourself, if the valuations are insane, if the historical ceiling has already been shattered, if even Warren Buffett, the man who buys during bloodbaths, is now sitting on more cash than ever, why is the crash still on pause? That's where the surface ends, and the real story begins. Because this is no longer just about stocks or investor confidence. There is a deeper force, one that has changed how the entire system functions. A force big enough to interrupt the natural boom and bust cycle itself. And once you see it, the mystery disappears. But before we expose it, here is the first pattern interruption to keep in mind. Markets done to stay irrational forever. They only stay irrational as long as someone is paying to keep the illusion alive. Soon, we'll uncover who's paying and why. Every financial bubble has a moment where the data stops making sense and nobody wants to admit it. That phase has already begun, because when you zoom out and look at the broader pattern, something is broken. For the last century, markets moved in cycles. Excitement, money flows in. Overvaluation, smart money exits. Panic, the crash resets the system. Recovery, new investors enter at the bottom. Cycle repeats. Boom, bust, reset, repeat. But today, something unnatural has interrupted that rhythm. We're at the top of the cycle. Valuations are extreme. Yet the big players aren't selling everything and walking away. They're still in the game. And that tells us this is no longer a normal market. Something underneath is holding up the floor that should have already given way. The signal becomes impossible to ignore when you look at the single biggest source of money in the entire economy. Not Wall Street, not hedge funds, not tech giants, the U.S. government. Every year it collects roughly $5 trillion in taxes, and every year it spends every dollar and then borrows trillions more on top of it. That money doesn't vanish. It enters the bloodstream of the economy, into Social Security checks, into military contracts, into Medicare payments, into government workers' salaries, into interest payments on the national debt. And where does that money end up? Right back into corporate earnings, the same corporate earnings that determine stock prices. So the market isn't rising because companies are producing more value. It's rising because the government is pumping borrowed trillions into the system, keeping demand artificially alive. It's like a patient in a coma being kept alive by a machine. The chart looks healthy, but pull the plug, and everything flatlines. And right here is where most people stop thinking. They see the spending, they see the stimulus, they assume it's a temporary boost. But it's not. Because the real question isn't, why hasn't the market crashed? The real question is, why has the U.S. government chosen to overspend by trillions every single year on purpose? That's the warning signal almost nobody is decoding. And once you understand the real reason behind that spending, everything else suddenly makes sense. Before we go there, here it's the second psychological checkpoint. If this feels like the calm before the storm, it's because it is. Crashes don't start with panic. They start with silence. The silence is ending. To understand the danger of what's happening now, we need to look back at the last time America believed it had outsmarted the cycle. The year was 1999. The internet was exploding. Money was cheap. Everyone believed a new era had begun, one where old economic laws no longer applied. Stock valuations soared. Companies with no profits were worth billions. People quit their jobs to day trade from home. Sound familiar? The Buffett indicator hit 115%. Analysts said it didn't matter. Politicians said growth would pay for everything. The public said this time is different. Then the illusion snapped. The bubble burst. The Nasdaq fell 78%. Trillions of dollars in paper wealth vanished. Pension funds were destroyed. Retirement dreams evaporated overnight. And here's the most important detail everyone forgets. The warning signs showed up 2 years before the crash actually happened. The numbers were already insane. But the market kept climbing. Just like now. Because bubbles don't pop when they're irrational. They pop when the next dollar of belief disappears. And in 2000, it disappeared fast. The new era economy became the dot-com disaster. Microsoft fell 60%. Cisco fell 86%. Amazon, 95%. The narrative shattered. Reality took back control. And all the people who thought nothing bad can happen as long as the market is going up learned the lesson the hard way. But here's the key difference between then and now. In 1999, the market was at 115% of GDP. Today, it's 216%. In 1999, the government was running a surplus. Today, It's running $2 trillion deficits. In 1999, stocks were overpriced. Today, they're beyond pricing logic altogether. So if a market at 115% ended in a 60–80% collapse, what happens when the bubble is double the size? Most people only prepare after the crash begins. The smart minority prepares when everything still feels fine. Which group you belong to is decided long before the headlines turn red. And just when the world thought it had learned its lesson, history repeated itself again. Not in the tech sector. This time, in the housing market. After the dot-com crash, the world swore it wouldn't repeat the same mistake. No more irrational bubbles, no more blind speculation, no more "this time is different." And for a moment, it looked like the lesson had been learned. Then came 2008. But this bubble was more dangerous. It wasn't built on tech stocks or startup hype. It was built on something people trusted more than anything: homes. Real estate felt safe. Banks said it was safe. Families believed it was safe. Until the truth surfaced. Just like today, the warning signals were everywhere. Mortgage debt was exploding. Banks were packaging toxic loans into AAA investments. Housing prices were rising far faster than wages. And the entire system depended on one belief: home prices never fall. But bubbles don't need new assets. They only need old lies dressed as certainty. In 2006, the housing market peaked. In 2007, cracks appeared. By 2008, the illusion collapsed. Households were wiped out. Banks failed. The stock market fell 57%. And once again, the most terrifying part wasn't the crash itself. It was the confidence that existed right before it. 2 years earlier, every expert said the same thing. The system is stable. The risk is contained. There is no reason to panic. Sound familiar again? Because just like today, the market was rising. The public believed the good times would continue. The institutions quietly exited first, and the pain fell hardest on the people least prepared. But here it's the deeper connection most people miss. Both crashes, 2000 and 2008, were caused by the same core belief: that the system could defy gravity forever. Tech couldn't. Housing couldn't. And neither can today's market. But this time, the bubble is bigger. The leverage is higher. And the illusion isn't hiding inside one sector. It's hiding inside the currency itself. We are no longer inflating stock prices with hype or housing loans. We're inflating them with borrowed dollars, with government deficits, with artificial demand, with a temporary lifeline that can't last forever. And just like every bubble before it, the end comes not when people know it's dangerous, but when the last buyer finally asks the forbidden question: what happens when the music stops? Because it always does. And that brings us to the present, the era where nothing looks broken, but everything underneath is quietly cracking. On the surface, everything looks normal. The stock market is near all-time highs. Unemployment is low. Headlines celebrate resilient growth. Analysts talk about a soft landing. And the average investor has stopped asking hard questions. It feels safe, but that's exactly how every late-stage bubble feels, right before the air disappears. Because what most people don't see is this: the strength of the market today is not built on productivity, not on innovation, not on organic demand, but on debt. Record-breaking, historic, impossible to sustain debt. Consumers are running out of savings. Credit card debt is at all-time highs. Household interest payments just hit the most expensive level in U.S. history. The government is borrowing $1 trillion every 100 days just to stay alive. And yet the system keeps moving, because the illusion must continue. The government spends money it doesn't have. Corporations report earnings boosted by inflation. Investors pretend that numbers going up equals economy getting stronger. And here is the most dangerous part. As long as the illusion holds, people believe they don't need to prepare. They stay fully invested. They take on more risk. They assume that because the crash hasn't happened yet, it won't. That is the psychological trap. When people stop fearing the fall, that's when the fall becomes unavoidable. Because every system built on artificial support has a breaking point, and we are closer to that point than anyone wants to admit. The Treasury is issuing debt faster than buyers can absorb it. The Federal Reserve can't print without reigniting inflation. Interest payments alone are now larger than military spending. Foreign countries are slowly exiting the dollar system, and the wealth gap has entered a phase history books call pre-revolt levels. But instead of panic, what do we see? Calm, optimism, blind confidence. The classic final stage before every historical correction. The calm isn't safety, it's sedation. If you wait until the crash is obvious, it will already be too late. Preparation is not something you do after impact. It is something you do while everyone else still thinks nothing is wrong. Because the next phase is no longer about whether the system breaks. It's about what breaks first. The currency, the bond market, the government's ability to borrow, or the public's belief in the system itself. One of them will go. And when it does, the illusion ends. Every bubble ends the same way, not when the numbers stop working, but when the belief system holding it together finally cracks. Right now, the market is being kept alive by one final assumption. The government will always step in. They won't let it collapse. That belief is the last pillar, the final layer of psychological insulation. The reason millions feel no urgency to prepare. But here's the truth almost no one wants to face. The government no longer has the tools it used to have. In 2000, it cut rates. In 2008, it bailed out the banks. In 2020, it printed trillions. But today, rates can't be cut without reigniting inflation. Money can't be printed without destroying the dollar. Debt can't be expanded without triggering panic in the bond market. The three emergency levers that saved past crises are now the very things causing this one. That is the trap. The public thinks the fire extinguisher still works. But what they don't see is that the extinguisher is already empty. The cracks are already visible. Treasury auctions are struggling. Nations are moving reserves away from the dollar. Inflation is not dead, only sleeping. The interest on U.S. debt is compounding faster than economic growth. And the only way out now is the one path no politician will say out loud: let the currency fall. Because when a government can't default honestly, it defaults silently. Not by saying, "we can't pay you," but by paying you in money that is worth less every year. That's the quiet crash already happening beneath the surface. Not a stock market collapse, a currency erosion collapse. And that is why the rich aren't fleeing the market. They're simply betting on a different outcome. Not stocks go up, but the dollar goes down. That is the real game. That is the hidden strategy. And the final psychological trap is this. Most people will not notice the collapse until it has already happened, because it won't look like a crash. It will look like life just getting more expensive. Slowly, then all at once. Gas goes up, rent goes up, groceries go up, savings buy less, retirement plans fall behind. And the market, at first, still looks fine. That's how silent collapses work. The chart doesn't fall. Your purchasing power does. And when the moment finally comes, when the belief breaks, when the buyers disappear, when the illusion ends, there will be two groups of people. Number one, those who saw it and prepared. Number two, those who felt it and panicked. Because the crash doesn't punish ignorance. It punishes delay. And that brings us to the end game. The point where denial is no longer an option, where the narratives fail, where the math takes over, where the winners and losers separate in real time. The question is no longer, will the system break? It's, who will be on the right side of it when it does? In the end, every chapter of this journey was never just about the world we walked through, but about the world we built within ourselves. From the first step to the final breath of this story, one truth became impossible to ignore: that time does not wait, memories do not stay, and the only thing that ever truly belongs to us is the meaning we create. We chased wonder. We wrestled with doubt. We stood at the edge of what we thought was possible, and discovered that limits were never walls, only doors waiting for courage. And somewhere between the questions we asked and the silence that answered, we became something more, not just observers of life, but authors of it. If there is one lesson this entire journey leaves behind, it is this: nothing changes until you decide it should. The world will offer noise. People will offer opinions. Life will offer distractions. But meaning, purpose, direction, those are built by choice, not by chance. So before you step away from this story, pause, breathe, and ask yourself, what will I do with the time I still have? Because the story is not over. Not yet. Not for you. Your next chapter is unwritten. Your voice is still rising, and the world is still listening. If this journey moved something inside you, don't just keep it. Continue it. Share the message. Start the project you've delayed. Become the voice someone else is searching for. And when the doubt returns, as it always does return to this truth, you are not here by accident. You are here because the story needs you. The world doesn't change when more people speak. It changes when more people speak with purpose. So go. Write the part only you can write. Live the chapter only you can live. And when your story echoes back one day, let it say, I did not watch life happen. I became it. If you believe more people should hear messages like this, then be the one who helps it reach them. Tap like, hit subscribe, and turn on the notification bell. Not for the algorithm, but for the impact.